Welcome everybody to this new meeting on the Financial Line Seminars. And today our guest is Lisa Warenski from CUNY and Connecticut University. So she has two jobs. And I'm very happy to have Lisa here today with us. And it's a very active member of the community. So thank you, Lisa, for everything you're doing for the finance network and the community of the philosophy of finance and money. And Lisa will deliver a very interesting talk titled Risk Management from an Epistemic Point of View. And so risk management is one of the main functions of the financial systems and the financial markets. So I'm looking forward to listen to what you're going to say. So thank you again, Lisa, and the floor is yours.
Okay, so welcome to my talk. I'll begin with an overview. I'll be introducing a way of thinking about risk management in banking and financial institutions that I think could be helpful. This way of thinking is to adopt the epistemic point of view in order to develop what I call organizational good epistemic practices. I will look at some notorious cases of risk management failures in the banking industry by way of illustrating the need for organizational good epistemic practices. So the aims of my talk. First of all, I'll try to make intelligible the notions of good epistemic practices and the epistemic point of view. I'll explain why good epistemic practices are needed, and I'll illustrate how good epistemic practices can be developed. Let me say a few words here about risk management. I'll be understanding risk management broadly to encompass risk management as it is practiced throughout a financial institution. Risk management is sometimes understood more narrowly as mathematical modeling of risk. This is but one component of firm-wide risk management. The broader notion of risk management is illustrated by the 3 lines of defense, 3 LOD model, which was adopted by the U.S. Office of the Comptroller of the Currency in 2014 as part of their heightened standards for banks operating in the U.S. The 3 LOD model is one component of the standards for the design and implementation of a bank's risk governance framework. So let me say a little bit about the 3 lines of defense model. The first line of defense would be the frontline units, business units, or functions whose roles engage them in identifying and managing risks. These groups are the bank's primary risk takers, and they are responsible for managing the risks associated with their activities in such a way that is consistent with the bank's established risk appetite and risk limits. The second line of defense is integrated risk management, IRM, which oversees risk-taking and assesses risks independently of the primary risk takers. IRM is responsible for identifying, measuring, monitoring, and controlling aggregate and emerging risks firm-wide. The third line of defense would be internal audit, which is responsible for providing independent assurance that risk management initiatives are effective. So the term epistemic may be foreign, but epistemic evaluation is familiar and ordinary. And I think Will Fleischer, in a forthcoming paper in News, gives a clear statement of this. When someone engages in wishful thinking, trusts irresponsibly, or jumps to a conclusion hastily, they fail in a distinctive way. On the other hand, when someone trusts responsibly, gathers evidence from a variety of sources, and bases their beliefs on good evidence, they succeed in a distinctive way. Evaluating people based on this specific kind of success and failure is familiar and ordinary. While the term epistemic is a philosophical term of art, it names this ordinary way of evaluating people's performances and attitudes. So let's look at some examples of epistemic failings in risk management. Risk management failures often have epistemic elements. And this should come as no surprise. Risk management involves making judgments about risk, and making a deliberative judgment is an epistemic activity that aims at true belief or accurate prediction. Risk management is thus inherently epistemic. I will consider some examples of epistemic failings in bank and financial institution risk management that I have discussed in some detail elsewhere. Okay, the first one will be familiar to most of you. This concerns the credit ratings in the 2008 global financial crisis. The buyers of mortgage-backed securities and collateralized debt obligations, CDOs, were institutional investors staffed by sophisticated financial professionals. The novelty and complexity of the securities should have prompted the purchasers of the securities to do their own due diligence, despite the fact that they were rated by the major credit rating agencies. But some of these institutional investors failed to perform due diligence. And this is documented by the Financial Crisis Inquiry Commission in their report from 2011. So what's the epistemic failing here? Well, to have accepted a rating without performing due diligence in this context was a form of unwarranted acceptance of testimony. The second example drawn from the global financial crisis concerns institutional risk management. Large financial institutions that failed or nearly failed during the 2008 global financial crisis had substantial and highly concentrated exposure to the housing market through mortgage-backed securities and CDOs. According to the US FCIC report, some firms were unable to aggregate their housing risks across various lines of business, with the result that they were not fully aware of their total residential real estate exposure. Those firms who understood their total position were able to move to sell or hedge their risk before the market collapsed, but those who did not were stuck with toxic assets. The epistemic failing here would be a failure to integrate important information at the institutional level, resulting in institutional ignorance, and I might add a misalignment of actions with preferences. A third example that I'll look at is drawn from JP Morgan's 2012 London Whale trading losses. In early 2012, traders in the London office of JP Morgan Chase lost more than $6.2 billion in the credit derivatives market. The magnitude of these so-called London whale trades roiled the global credit markets and shocked the investing public. In late 2011, the bank needed to reduce its risk-weighted assets, RWA, in order to comply with the soon-to-be implemented new Basel Accord standards. The bank's chief financial officer directed the head of the chief investment office, the CIO, to reduce RWA, and he assumed that the reduction would be achieved by unwinding some of the positions in CIO's portfolio. But unwinding the positions in the CIO's portfolio would have resulted in large losses. Subsequent conversations amongst the bank's senior management led the head of the CIO to believe that there might be some flexibility with respect to the amount and timing of the reduction to RWA that was needed in the CIO. Accordingly, the head of the CIO directed her traders to reduce RWA in a way that minimized losses. The failures to vet both the decision to not unwind the positions and the trading strategy that ensued were crucial missteps that led to the losses. So the epistemic failing here was a failure to subject materially significant judgments about risk and risk management strategies to critical peer review. So let's take a look at what some good epistemic practices would be, and I'll try to argue that these might have helped mitigate or avoid the epistemic failings. So let's take a look at this. Okay, so a practice is just simply a way of doing things. An epistemic practice is a practice that is oriented toward the realization of an epistemic good. So what's an epistemic good? Well, an epistemic good is something that has value from the epistemic point of view. Following many epistemologists, I understand the epistemic point of view to be the perspective of valuing truth. Epistemic goods include, but are not limited to, knowledge, understanding, and justification. Epistemic goods may be value-bearing mental states, for example, understanding or well-founded judgment, or they may be properties that have epistemic value, for example, the coherence of an explanation or the justifiedness of a belief. So what would organizational good epistemic practices be? Organizational good epistemic practices are epistemic practices within an organization that tend to realize an organization's epistemic goals or otherwise promote the attainment of epistemic goods. The development of good epistemic practices proceeds, in a way to be explained, by identifying epistemic aims and then reasoning about how best to achieve them. When we reason about our epistemic aims and how to achieve them, we take up the epistemic point of view. To take up the epistemic point of view is to adopt a distinctive perspective that facilitates the framing of epistemic challenges and the development of their solutions. So how would we go about constructing these? Well, step one would be to identify some general epistemic aims and guiding epistemic principles. We would then develop more fine-grained and domain-specific action guiding principles that accord with these general aims and principles. And finally, we would learn from experience to add to or modify the principles accordingly. And we have a model for this kind of construction in generally accepted accounting principles. So let me just illustrate. Okay, so accounting best or good practices are established by the International Accounting Standards Board, IASB, for most parts of the world, and by the Financial Accounting Standards Board, FASB, for the US. Accounting best practices are a common set of principles, standards, and procedures that guide representation of financial information. For example, FASB's concept statements are general guidelines that establish objectives and concepts that in turn guide the selection of economic phenomena to be included in financial reporting. The concept statements inform the board in their development of specific accounting guidelines. So these would be analogous to the general good epistemic practices and the general principles that are employed in them. Then we have more specific guidelines that are developed. So the accounting guidelines in their totality are under continuing review in order to reflect changes in methods of doing business and changes in the economic environment. So the picture is the general statements or general objectives and the concept statements are used to guide the construction of more specific accounting rules and procedures. And then together, these form the accounting guidelines. And these guidelines in their totality are under continuing review. So let me look at some examples of good epistemic practices. What might be a general one? Well, one general thing an organization wants to do is promote good judgment. So the organization will implement and maintain organizational structures and systems of controls that promote good judgment. So an organizational structure that promotes good judgment is going to be a structure that specifies the functional roles of various subgroups within the organization, the personnel within those subgroups, and the relations between subgroups. Systems of controls that promote good judgment will be codified policies, procedures, and guidelines, where these may include directives to engage in constructive critical evaluation. So another general principle that would be important would be what I call the effective transmission of epistemic goods. An organization will want to implement and maintain organizational structures and systems of controls that are designed to ensure the transmission of epistemic goods to key decision makers. So the transmission of epistemic goods is required because there is division of labor in a corporation. The transmission of epistemic goods will be effective when the epistemic goods get to the right people. These are the key decision makers. And by a key decision maker, I don't mean senior management. I mean whoever is, going to be making a particular decision, and this could be throughout the organization. In addition to action guiding principles, general organizational epistemic principles might include statements of epistemic aims and values. Okay, so we get some general principles, and from those we need to develop more fine-grained and domain-specific organizational good epistemic practices. So how would we go about doing this rather? Well, let's return to our examples. All right, so the first example I gave had to do with the credit ratings in the 2008 global financial crisis. The buyers of mortgage-backed securities and CDOs were institutional investors staffed by sophisticated financial professionals, but some of these institutional investors failed to perform due diligence. So what would have been the good epistemic practice here? Well, it would have been to conduct independent analyses of novel and complex securities, in this case CDOs, that present special challenges for the evaluation of the probability of their default. More generally, we should not rely on the testimony of sources whose expertise in a particular area could reasonably be called into question. We should make our own assessments. Second example had to do with institutional risk management, again in the global financial crisis. Some firms were unable to aggregate their housing risks across various lines of business, with the result that they were not fully aware of their total residential real estate exposure. The good epistemic practice here would have been to implement systems for collecting and aggregating data about subprime mortgage exposure in all business lines that assumed risk in this area. More generally, an organization should develop and maintain procedures to collect and aggregate risk data in order to assess whether actual risk exposure accords with preferred risk exposure. And the final example I looked at had to do with the London whale trading losses. And again, the traders in the London office of JP Morgan Chase lost more than $6.2 billion in the credit derivatives market. The head of the CIO had directed her traders to reduce RWA in such a way that minimized losses instead of simply unwinding positions. And the failures to vet this decision and the resulting trading strategy were the crucial missteps that led to the losses. So the good epistemic practice here would be to subject trading strategies to rigorous analysis and questioning prior to implementation. The organization should identify risks for the strategies and ways to mitigate these risks. A more general statement here would be to subject materially significant judgments about risk and risk management strategies to critical peer and management review. Okay, so let's look at the levels here that emerge from this kind of construction. We have the general high-level principles, and the two examples I gave were the promotion of good judgment and the effective transmission of epistemic goods. And then we have more fine-grained but still fairly general principles that are either derived by thinking about the epistemic goals themselves or by generalizing from corrective actions taken in response to past failures. And then we also have the fine-grained domain-specific good epistemic practices. So the selection of good epistemic practices follows the model of organizational double-loop learning as developed by management theorist Chris Argyris. Single-loop learning is a process of correcting errors and making adjustments to comply with the requirements of accepted goals, strategies, and values. Double-loop learning, by contrast, takes the assumed goals, strategies, and values themselves to be subject to modification in light of experience. And this is the model I suggest that good epistemic practices would take. You have the high-level principles and then more fine-grained but still fairly general ones, and even more fine-grained domain-specific ones. And these are in principle subject to revision as new situations are encountered, and the organization can make adjustments accordingly. Okay, so the construction of good epistemic practices, and a kind of recap here. When analyzing an organizational failure from the epistemic point of view, we rationally reconstruct the events that led to the failure with the aim of identifying epistemic failings. To identify possible corrective actions, we formulate guiding epistemic principles that we think will improve epistemic performance going forward. The efficacy of these remedial epistemic principles, or lack thereof, is to be established in their ongoing application. Good epistemic practices may be developed in response to past failures, but they may also be developed by reasoning about how best to achieve organizational goals. What's the utility of the good epistemic practices approach? Well, the good epistemic practices approach to risk management provides a conceptual framework for identifying and endeavoring to achieve various epistemic aims that are implicit in effective risk management. Endeavoring to identify the epistemic aims of risk management brings these aims more clearly into focus, which in turn helps us to be guided by them. When things are going well, the directives of good epistemic practices may seem superfluous, but violations of them can lead to disastrous consequences, as the cases of risk management failures that I have discussed illustrate. The point of articulating and managing for good epistemic practices is to better enable us to keep their demands in mind. So in conclusion, organizational good epistemic practices are epistemic practices within an organization that tend to realize an organization's epistemic goals or otherwise promote the attainment of epistemic goods. The development of organizational good epistemic practices proceeds by taking up the epistemic point of view in order to reason about organizational epistemic aims and how to achieve them. Adopting a good epistemic practices approach to risk management provides a conceptual framework for identifying and endeavoring to achieve various epistemic aims that are implicit in effective risk management. Past epistemic failures illustrate the need to keep the demands of good epistemic practices firmly in mind.
Thank you very much, Lisa.
Okay, I got it. All right. Just trying to get back to you.
Fascinating talk, and there are a lot of questions, I guess, coming from the audience.
Good. Okay.
And yeah, I mean, we can open the debate now, and the people willing to pose questions can raise their hands virtually. I don't know if there are people from the audience. Yeah. We also have a question coming from in the chat box, coming from Miguel Alzola.
Okay.
But we can start with Federico Donato. Thank you, Federico, for being.
Yeah, thank you for your talk, Professor Warenski. It was fantastic. I have by the way, I'm from SUNY Buffalo, PhD student. Definitely, there are epistemic problems that we require epistemic solutions, and who better than epistemologists to tackle these problems? But then I thought, how to implement the solution? Because are we, for example, asking to have epistemic consultants in the firms, banks, and financial institutions? That would be maybe one idea for the future. Very interesting also to see philosophers outside academia helping the world. But also you mentioned informatic systems. So besides maybe raising awareness to key decision makers or low-tier accountants and so on, can we implement these things, maybe epistemic formulas, schemas, practices into some decision support systems in some way? Have you ever heard of these kind of solutions? Because that would be interesting also on informatics level.
Yeah, okay, good. Thank you. Yeah, this question of how, I didn't talk much about this. It would be not impossible, but I think rather surprising for banks to hire epistemologists in this capacity. I don't think that's the mindset. What I think needs to happen if this is to be taken up is I think the idea of epistemic practices needs to become part of the conversation. It has to be, something that is not discussed only by philosophers, but by, the general public, more broadly. So when I think about how this could be implemented in a bank, there are really three things that come to mind. There are probably more things. This idea of having it in the systems, which you just suggested, is a very good one and not something I thought of. But when I'm thinking about how banks might implement this, I see three ways. One way is to include it in the documentation. So a bank typically has something called a credit manual, and this lays out, how credit decisions are to be undertaken, what is the procedure, so on and so forth. So it could be in documentation. Say you have a risk management manual. That's one way. It can also be done through in-house training. So oftentimes a financial institution will, take a day to train people in a particular area that, is important to the bank. Maybe you get training in foreign currency or in, credit default swaps, this kind of thing. And the third, and I think most important way, is for it to be part of the conversation. So this is, you have to have, probably starting at the senior level, senior managers starting to talk about epistemic practices, and that becomes part of the conversation when the bankers are talking about credit decisions, when they're talking about risk management, when they are evaluating system structures and controls, so on and so forth. So it's to get it into part of the conversation. And one thing I'm thinking about now, what I'm wrestling with now, is trying to figure out how could this be done? I think you can't just, launch into it like an epistemologist. You've got to give a financial institution something simple that they can get their heads around, something like the three lines of defense model. Okay, that's simple. There are 3 lines of defense, 1, 2, 3. And that's something people can understand. So I want to boil it down into something you could give an institution that they can understand and work with. It has to be a tool that they could work with. So I'm trying to think about how to do that, and I don't have an answer yet. Part of the stumbling block has been this term epistemic. When I talk to people in banking, they just get flustered when they hear the word. And I was talking to a former boss of mine about this idea, and he says, every time you say the word epistemic, I feel like someone is taking a string and pulling on my toenail. It's painful. So we've got to get past that somehow. Now, this is really interesting, what you suggest about having, epistemic directives, I guess, or checks as part of a system, an intelligence system. And I actually wanted to ask you if you could say a little more about that. I think that's really interesting and could be potentially productive.
Yeah, so I'm not an epistemologist. I'm in applied ontology, and which means, what does it mean? So now it's becoming like a word, like a buzzword. And so I have a background in metaphysics and logic, and we are applying some schemas, some principles in various domains, like biology. Now, finance would be the next step. And also for the Department of Defense, we have some contracts and collaborations. So surely epistemology can be a strange word for the rest of the continent, for everybody outside of philosophy. But definitely they have these problems. They just don't know. So the way is like selling these things with the concepts and with the keywords that they already have. In a way that they understand immediately. Yep. So we collaborate with people that are not in philosophy, definitely never had a philosophy course in their lives. But so definitely I sense completely, I can feel the difference, but also we are training to get to their levels, and there are successful stories about that. There will be in the future an ontology of epistemic stance epistemic attitudes. This is under development. I myself work a bit on the ontology of risk. So what is risk, definitions to connect it with risk propagation and things like that is just at the beginning. There are also other groups, not many, but that they are working on that in other countries. And there are ways of like sneaking into these kind of institutions and provide a service to them. They don't know the problem. We can explain that there is a problem and also the solution. So
yeah.
yeah.
Could I ask in what capacity are you working with these organizations? Are you part of the organization? Are you consulting? How are you?
No, usually consultancy, and we have either students or former students that are either consultants or are inside. Actually, no. Since I'm not an American citizen, I cannot. But we have PhD students that are in these organizations, like working full time. So yes, definitely.
Yeah, no, I'd be interested in communicating with you about what you're doing, because I am starting to think about how could I practically, apply this.
Yeah.
And this may not have been apparent in any of the materials on Emiliano's website, but I did spend a considerable amount of time in the banking industry. I have over 8 years experience as a corporate credit analyst and loan officer, and that's how I got interested in this. When the financial crisis happened, certain things just leapt out at me, having both the background as a banker and then being an epistemologist. So certain things just jumped out. And I was initially looking at the situation, trying to think about at what point could we have put on the brakes? At what point, or how could we have done better? And what, as I say in the talk, what policies could we adopt that would help us do better going forward?
There are steps to take from theory to practice that can be done. I don't want to take too much time on the conversation.
Okay.
I'm sure there are other questions, but we can chat maybe with emails. Like.
Okay, good. Thank you.
Also, yes, thank you very much for your interaction. And we have questions coming from the audience, but they are on the chat. Maybe I can read them if you agree, Lisa. There is a question coming from Miguela Alzola. And he says, "Great paper, Lisa. Sorry, I have a meeting at noon. I have many questions about the notion of due diligence in place here. For example, about the 2008 financial crisis, what is the point of credit rating agency if we have duties of due diligence to make sure that they do their work well? Are not they supposed to be a sort of epistemic intermediaries?"
Okay.
I hope to be able to discuss these questions.
This is a good question. And this came up, this was discussed, fairly widely after the global financial crisis. The problem with the collateralized debt, the CDOs, the collateralized debt obligations being rated by the credit rating agencies is that these were extremely complex creatures. They were not the kind of security that the credit rating agency usually looked at. What the ratings agencies did routinely and what they do well is to issue ratings, on bonds for, corporations, so they're in effect issuing credit ratings, on the underlying, company, that they're not involved in rating derivatives. This required a completely different kind of model. It's a completely different animal. It's not the same as, looking at a company and evaluating its creditworthiness and issuing a rating that is supposed to indicate the probability of fault of a particular instrument. These ratings, these collateralized debt obligations were completely different than the kind of things that the rating agencies usually rated. That's the problem. They were novel, not just to, institutional investors. They were novel to the credit rating agencies, and institutional investors know perfectly well what the rating agencies do on a regular basis and what they do well. This is something new. So at the very least, they should have tried to understand the methodology that the rating agencies were employed. And in the, I mentioned earlier this investigation by the senior supervisors, when they were looking at how these financial institutions handled the financial crisis, they noticed that some did try to do their own analysis of the CDOs, and one even tried to sell, some of their securities in the market just to see what the real value was. So they're testing, the CDOs and testing their value by, and analyzing themselves and even, selling them and seeing how the market reacts. So it was the novelty that was important here. And, the institutional investors would have known that these were new to the credit rating agencies. So that's why in this case, unlike in the case of a plain vanilla, situation, you would, be expected to do your due diligence. But that's a very good question. It's one that came up frequently after the global financial crisis.
Yeah, thank you very much, Lisa, for this clear answer. And there is also another question coming from the audience in the chat, and from Like Froberg, hope the pronunciation is right. And the microphone is not working. And she has two questions. The first one, regarding the good epistemic practices, while it seems commonsensical to consider the aggregate risk after the fact, we can have reasonable expected them to have considered this risk. Potentially, they could be dozens of ways to improve their risk management. So how do we determine whether it was a blameworthy failure or just a learning moment, also known unknown, turning into known unknown? That's the first question.
Okay,
And the second one, I don't know if you want to listen also to the second one, or.
Well, let me try this. I think if I understand the question correctly, the question is, how do we know when something is commonsensical and should have been obvious, as opposed to when it's a new situation or an unknown? And, first thing I want to say, what seems obvious to one person might not seem obvious to another. What seems obvious to one institution might not seem obvious to another. So in looking at this, to my mind, the question about aggregating, that seems obvious, to me, but then the institutions I worked for did that. But for various reasons, another institution might not have thought to do that, to aggregate their entire exposure to, to the residential real estate market. So I think the point of the good epistemic practices is, and this is why some of the, a couple ones I laid down were kind of commonsensical. I mean, this was not a radical new principle. It's the kind of thing that, you might think of. The point is to kind of lay down what the general goals are and then develop more specific practices from there. Now, which ones are going to be commonsensical, which ones are novel, people can debate. People can debate that. I think where the question becomes urgent is when we are trying to determine responsibility. So, who is to blame? To what extent do these corporations, bear responsibility for the actions they took? How do we accord blame? And then you've got to make some judgments about, what they should have known, what was reasonable that they might not have known, this kind of thing. So I think those are judgment calls, and you've got to look at the particulars of this situation. And, the defense, I remember the credit rating agencies said, well, we made mistakes, these were just mistakes. Other people would say, no, well, they should have known better. And that would be my position, when the ratings were assigned, but, their defense was, we just made some mistakes. So I think you've got to look at the particular case of an epistemic failure and then try to decide, should the company have known better, or is this a case where it was a more honest kind of error? Okay, I hope that answers the question. Maybe the questioner has a follow-up, I don't know.
There is a second question. And
okay.
It says, on a philosophical, conceptual level, how is risk related to and differing from due diligence?
How is risk different from and related to due diligence? Okay. Well, due diligence is, just checking to see, that things are the way they are presented or that you understand the situation. Risk, and I mean, there are different accounts of risk. And the most kind of simplistic, kind of ordinary concept of it, I think would be just, the risk is, the possibility of a negative outcome. So the taking a risk is, the possibility of some negative outcome. And when you take a risk, you try to, achieve a positive outcome, but, you're aware that things might not work out. You take the risk because the probabilities are in your favor. Due diligence then is the investigation of the information that you base your decision to take the risk upon. I think that's how I'd say it. So I think due diligence, if you're taking a risk, you want to do your due diligence so that you are confident that the risk you're taking is based on good information, on accurate information, and all the information that is relevant to make that risk decision. And that's how I'd put it.
Okay, thank you, Lisa. And we have now a question coming, a live question coming from the audience, from Hervé Glogwen. I hope the pronunciation is right. So thank you, Hervé.
Thank you, Hervé Glogwen, indeed. Thank you. That's a good pronunciation. Professor Warenski, thank you for your presentation. I'm absolutely not close to philosophy. I'm more a practitioner.
Okay.
I'm currently a doctorate student in Bocconi, but I was for many years the head of audit of the Allianz Group. And then the head of compliance. So I'm vaguely familiar on these topics. Two questions / remarks. The first one is that for second line on the risk management function, I think regulation plays beyond good practices, or you might say it's a practice, but I think regulation in the sense of capital requirements, Basel III in the case of banking, is a strong contributor to define risk appetites and then limits. And that's probably part of the conversation. And second, I believe that the system of incentives, or rather risk / rewards systems, play also a very important epistemic role, if I got that correctly, in the sense that it should define the right balance between or the right definition of a risk appetite. Actually, the example I have from very recent case is the Wells Fargo case, which is not only a failure from the first line perspective, but also on the second, even third line. You may have seen the news whereby the chief auditor and the chief risk officers and a number of executives in Wells Fargo have been actually personally fined for failing their duties, probably in an intentional way, because they were actually rewarded in having a conflict of interest actually in the actual performance of Wells Fargo and mis-selling practices. So I don't want to be too long, but I think part of the good organizational practices are the setting of limit system and the capacity to break down capital requirements to the product level or portfolio level on the one hand, and on the other hand to make sure that the reward system are adjusted in such a way that first line is acting in alignment with the corporate value and the corporate goals, if that makes sense. Thank you.
Yeah, thank you. Okay, let me say something about the, 3 lines of defense model. So I was a little reluctant to use that because I think it oversimplifies matters. It makes it look like, there's an order. It's first line, people put the risk on, and then you've got the IRM, the, managers of the risk internal to the bank, and then audit. And it's much more holistic than that, and the policies, the risk appetite and, what kinds of policies result from that, are going to perhaps originate on the second line. It's going to inform the first line. So you're not going to get this kind of segregation that the model implies. The reason I brought it up is because I found, in the time I've been working on this, sometimes I talk about risk management and immediately people think of the quants doing quantitative modeling and that's risk management. No, risk management is much broader than that. But I didn't mean to imply that, first line of defense is driving, risk appetite and, the policies. It isn't, it's much more integrated. With respect to the incentives, yeah, absolutely. Incentives drive behavior, and that's crucial. How you incent is absolutely critical to, how people conduct themselves. I'm in thinking about the epistemic practices, I'm trying to kind of isolate the purely epistemic components. Now, you're never going to completely divorce the epistemic from the pragmatic, but I didn't touch on, incentives. There was certainly, bad behavior in the global financial crisis. There was also bad behavior in the London whale trades. As you may recall from the description of that case, you had the traders of the portfolio in which the losses occur, as those losses were happening, began to mismark the books, and they hid those mismarkings from their boss, basically. So that was egregious behavior. And so this approach, the epistemic approach, isn't addressing the moral conduct. It's trying to just look at the epistemic element. So you're absolutely right. Incentives are extremely important. Incentives can interfere with the free exercise of reason. If you think about the credit rating agencies, and you have this issuer pays model, how is the rating agency supposed to objectively give a rating, if that rating is being paid for by a paying customer? Problems here. So yeah, the incentives are absolutely crucial. And there's not a lot I have said about that really touches on that, but you're absolutely right. That's critical to corporate conduct.
Thank you.
Okay, thank you, Herbert. Thank you, Lisa. We have another written question coming from Rokas Vaisilius. I hope the pronunciation is right again. And the question is, what are the current financial risk phenomena, i.e. active in the present, that are relevant and interesting from your proposed view on the epistemic practices?
Right. Okay. So something other than just the business of banking. So I'm really just thinking about how financial institutions are operating. So this is the way I'm conceiving of this, is as a tool to just help financial institutions, go about their business and manage risk. What is special right now that would be addressed by this approach? I guess what leaps to mind is what's going on in the commercial real estate area, where you've got, loans that are in trouble, and people are saying we've managed to extend and pretend as long as we can. Something's, going to give. So I think maybe looking at what's going on in commercial real estate, that's one standout. Worries about private equity, what's going on there? Are we taking too much risk? That's another, but that's not, what I'm thinking of. This is really kind of a tool for, risk governance structures, within financial institutions. So that, isn't, directly applicable. Yeah, but I guess commercial real estate and private equity are the two risks that leap out. Now, the banks, of course, if we, go into a deep recession in the US, the banks are going to be hit because they have exposure, to the overall market. But that's, part of the business cycle. So they'll want to think about, and presumably they are thinking about, how to manage that risk. But I guess those are the things I see as problems. I don't see anything like the problem with the subprime mortgage market, lurking under the hood, as it were, of the banks. But maybe there is something out there. Okay.
So thank you, Lisa, for your answer. And I don't know if there are other questions coming from the audience. Otherwise, I have a question.
Okay. Yeah.
Maybe we have time for just one question. My question, so thanks again for your very fascinating talk. And my question is about the epistemic failure, in the sense that, I mean, the main focus obviously is the failure, not the success. And so how we manage possible eventual failure in our epistemic approach to the markets. And so my question is about the theories in place here. So if you have some commitments to a particular theory, I'm thinking of, for instance, of the heuristic and biases approach, Kahneman, Warenski, or the fast and frugal approach, Gigerenzer, Todd. And so in that case, you have two different viewpoints on what produces an epistemic failure. And maybe
Okay,
I can explain it a bit better. I don't know if it's clear or.
Okay, that's tricky. So, so I think I understand you're asking a question about, how to think about heuristics. Are they,
Yeah. In the sense that if you are committed to the heuristic biases viewpoint, for instance, you know that even though the agent, the financial agent, has all the data, the complete data, he can produce a failure because he can process the data in the wrong way. And so
right. Okay. So yes, and I do look at that in one of my papers. I think we have to manage for certain kinds of biases. So we have to be, and I think becoming aware of the kinds of biases that we might have, and then trying to manage for those, can help us. So you might have a system that would check for bias. So you have these checks and balances, and building something into those systems that can be a check on bias is going to be helpful. But if to the extent bankers are people, they're just reasoners. So to the extent that we all have biases that sometimes get in the way of good decision making, bankers are going to be vulnerable to those biases. So you try to correct for those. Some of the ways are through critical constructive dialogue, vetting decisions, but you can also have systems, where, that are built in ways to check for biases. So you want to check, to see if you've got some kind of gender bias in hiring. You can, build a system to give you information about that. So you are going to be checking for these biases. In terms of where do I come down, I think Gigerenzer is sometimes right. I think I'm not as we have biases, but I think probably the heuristics that we use served a purpose. They can sometimes fail us, but we can become aware of how they fail us and take corrective steps. I think that's how I would look at it. I don't have quite the delight that Kahneman and Tversky take in discovering the biases. I guess I'm more aligned with the psychologist Gary Klein, who studies expert judgment. And, I think that's perhaps more helpful for general, management in the banking system. But we do have to be aware that we have biases, and we want to take steps as part of all that, all our risk management activities. So we want to take steps to counter those biases.
Okay, so thank you very much, Lisa. And
one more question if we have time. I don't know.
Yeah, there is another question, a written question coming from, maybe it's the last one, coming from Christopher Gifford. I hope the pronunciation is right. He has two questions. The first one, how does causation figure in your account of epistemic risk? Is Gartner causation or Reichenbach causation relevant? And the second one is, how would you apply your account of epistemic risk to model risk? the risk of models? Those are the questions of Christopher.
Okay. You read the first one again. It's something about causation, but I didn't hear your second sentence.
Okay, so how does causation figure in your account of epistemic risk? Is Gartner causation or Reichenbach causation relevant?
Oh, good heavens. All right, that's a whole topic in itself. I don't have a particular account of causation in risk. I mean, there are many causes of risk, many ways in which, something could go wrong. Say you make a corporate loan, there are known risks that you look for, but, that something could happen that you couldn't anticipate. So there's going to be a plurality of risk. I don't have a particular view on causation that's relevant to what I'm trying to do here with risk management. I mean, that's, causation is a big topic. So probably, there might be certain views of causation that would be directly relevant to this general risk governance framework that I'm laying out, but I tend to think that most accounts of causation are, going to be accommodated, within the overall framework. Now, what was the second part again? It was about
how would you apply?
Risk. Okay, yeah.
Yeah.
Okay, yeah, I'm not the right person to ask about model risk. So when I was doing models, I'm doing term loan projection models. These require arithmetic and an understanding of managerial accounting. But I think there would be epistemic practices that would be helpful to modelers and that are relevant, certainly. I couldn't speak to the details there. I will mention that Christian Walter has done some interesting work on this topic, so that's someone whose work you might look at. But there would be good epistemic practices that bear on the construction of models, I would think, but I'm not in a position to say anything particularly informative about them because I'm not engaged in that kind of mathematical modeling.
Okay. So I don't see questions coming from the audience. Yes. So
Okay.
I think we can stop here. Thanking again, Lisa, for this very interesting and stimulating talk. And hope to see you again on the next Phinance Online seminars. So
Okay, yeah.
thank you, Lisa.
Thank you,
Thank
everyone,
everybody.
for